Okay, folks, welcome to the July version of our monthly call. I think broadly calm in markets, many markets, particularly in the States, pushing all-time highs, the NASDAQ closing in on that crucial 15,000 level. And we've seen a succession of new highs in the S&P. That comes, I think, against a curious market backdrop. Volatility is falling. We are seeing signs that inflation is picking up in the States. There is this debate of whether that is transitory or not. Most other asset classes are well behaved. Bond yields have fallen. Things to note and keep an eye on. We have some weakness across emerging markets. We have strength in the dollar. Higher risk assets like Bitcoin are weaker, I think, underbid. And I think a sense on our part that riskier equities getting into very, very expensive territory. So we're not minded, I think, to chase this. Daniel, I think, will give us more detail on portfolio moves. Daniel, let's chat a bit about inflation and bond yields. And, despite the commentary from central bankers that these high inflation numbers are transitory, they keep printing at high numbers.
Yes, that's right. And to be honest, I think we mentioned in last month's podcast, actually, it's not a great surprise to see inflation numbers at these levels when you're looking back on a year-on-year basis. Last year, the economy was clearly very weak. This year, it is picking up as the reopening happens. So it's not a big surprise that we have the numbers that we're seeing right now. The key question, which everyone's focusing on, is whether it is transitory or not. And some of the measures that have historically been quite helpful in gauging where it goes in the future is stuff like the credit impulse numbers coming out of China. It's not the only factor, it's one of many, but it's the one that a lot of market participants are looking at these days. And that really signals a slowing in inflation over the next 6 months or so. And I think that's why the bond markets are also signaling a similar story. Future expectations of inflation 5 years out, or even a break-even rate on Treasury inflation-protected securities. Those are bonds that are linked to inflation in the US. They're not signaling any real concerns about inflation. So my best guess is that we see another month or two of these high inflation numbers, and then we start to see it level off a bit and even fall back to more normal levels. How does that fit with your expectations, Mike?
Yeah, one of the things that I've been watching all year round is lumber prices, partly because they're a measure of a strong housing market, partly because they're a kind of a speculative index as well. And lumber prices, since the depth of the coronavirus crisis, I think had gone up like 4 times. Now has come right back off to where they were the beginning of this year. So that suggests, I think, that some markets think that this move is transitory. What I'm focused on really is the wage market, and whether you see a follow through in the wage market in terms of workers demanding new wages. There's plenty of anecdotal evidence that in the States and even in the UK that retail companies are having to make it more attractive for people to come back to work. And I think what we also need to see in that respect also is for some of the stimulus to work out of the system in terms of some of the measures governments have put in place. But I guess for the moment, the market is buying into this transitory story, and that's reflected in bond yields effectively across the world. And I think what's interesting as well is that we're not seeing any signs that the taper debate, the possibility that the Fed and other central banks will reduce purchases of assets, that's having an impact on prices either.
Yeah, it does remind me a bit actually of 2016 and when Donald Trump got elected. There was a lot of expectation for inflation then, and the idea that animal spirits would be invoked by his election, and we'd see a lot of inflation as a result. And it was a bit of a scare for the market for about 6 months. The bond market sold off, and then it started to basically go back to its previous trend. And it looks a bit like we're repeating that.
Yeah, exactly.
We'll see. The impact on the dollar is kind of interesting though, because at the start of the year, everybody in sell-side research thought the dollar was going down. And any time everybody in sell-side research thinks something, you look at the exact opposite and wonder if that can happen. And I think we've seen some signs of that over the last month or two as well. which does have an impact on the performance of stuff like emerging market equities relative to the developed world.
Yeah, exactly. And I think, as you said, the consensus was heavily in favor of a weaker dollar. Importantly, we also saw that in positioning. So in terms of where funds, hedge funds, and other investors were placing their bets, what we've seen actually is that they've taken a lot of those bets off, and the dollar has begun to rise. And I think if we begin to see the dollar rise more, that will put pressure on some emerging markets. Bear in mind that across the emerging market landscape, you have a range of political crisis, an ongoing one in Turkey, one that's beginning to erupt in South Africa, and they are two of the key emerging market currency countries. So I think emerging market volatility is something I think we need to be, we're obviously not badly exposed there, but I think investors in general need to keep a close eye on.
Yeah. And turning to more positive markets, the tech-heavy Nasdaq has really picked up in the last month or two. But there is a word of warning, because you were telling me about this great stat just before we started on how many days it is since we've last had a correction in the equity markets. What were the numbers again?
I mean, a kind of a 5% or so correction in, say, the S&P, which is the benchmark, is a healthy thing in any bull market, because it takes some of the speculative excess out of the market. Now, we've been, I think, about 172 days without one of those, which I think if you go back in history, we've only seen that. You see that kind of behavior maybe once every 2 or 3 years. So to say some sort of correction is overdue, I think is now stating the obvious, and people should, I think, just be that bit more cautious. And that also tells us, I think, of the overextended nature of the market environment as well.
Yeah, and that's why, for our clients, they will probably see on their portfolios that we carried out a rebalance of their accounts. And what this basically means is, because equity markets have been strong, if you were at 50% in equities in November, you were about 54 to 55% as of last week. And so looking at this market backdrop, we just thought it was a good time to do a bit of housekeeping and just reset those weightings by selling a bit of equity and buying a bit of bond and cash exposure. So that's what people will see going through over the next few days if they've not seen it already.
Good. Okay. I think it's a good footing to be on as we head through the rest of the summer. So look forward to updating people again in August. Yeah.
Sounds good. Thanks, Mike.